Hello everyone, welcome back to A Beginner's Guide to Investing. It is once again your host Ruhan Gupta. This is episode 4, and in this episode, I'll explain how you can invest in mutual funds explicitly. In the previous episode, I outlined the basics of investing in bonds, so do check that out if you haven't. And another thing to note is that many things I mentioned in this video, I expect you already have knowledge of this because you have watched the second episode where I detail both bonds and mutual funds. So if you do not have an entire comprehension of mutual funds, do check episode 2 out before starting this episode. Anyways, let us start addressing mutual funds. When we invest in mutual funds, we are entrusting our funds onto two authorities, the fund manager and the AMC. Remember, the AMC is the firm that manages the fund. It is the firm which basically initiates the fund, the one that owns the fund. Think about it this way. When we lend money to a friend or relative for their respective business ventures, we inquire about their intentions with our money and stability of their business. We do this to ensure they will have the ability to pay back the interest in time. We ought to carry out the same due diligence when we invest in mutual funds. You may ask, why is it important to scrutinize a fund? See, you're investing in a mutual fund to gain some sort of return down the line. This can range from 5 to 10 years, but is long term. It is always going to be long term. So we can certify that everyone puts their money into mutual funds for long term wealth creation, not short term formation. It is nascent and unwarranted to say you can make returns in the short term when it comes to mutual funds. Thus, we need to seek funds that are stable and less volatile over an extended period of time. We cannot invest our money into a fund that will only be successful and prosperous for a year. So this is our point of view. Now let us flip the point of view to the viewpoint of an AMC, to the perspective of an AMC. The fund, which is also the AMC, is not looking to create wealth for you in the long term. The AMC has employed capital to initiate this venture to gain revenue, and this capital is surplus. It is to an inordinate extent. To recover this revenue, to recover this investment, the fund needs to attract a multitude of investors who are willing to splurge to an excessive extent. We have covered this in a previous episode, wherein we delineate management and sales fees. When will a company attract investors? An AMC will only cajole investors when the fund proffers superfluous short-term gains with extensive marketing. These two factors, amalgamated, captivate the feeble-minded investors. However, this podcast teaches you to be the exact opposite. You cannot be enchanted and fall into these steps. What I essentially mean to say is that AMCs make their money from mutual funds through fees such as management fees and sales fees. Now, how are they going to make money through these fees? Well, when more people invest in the fund. And how are they going to get more people to invest in the fund? When they show short-term wealth generation. However, short-term wealth generation is never good in a fund. And I'll explain why later during this podcast. Hence, we have established that most funds are not looking to net you consistent returns over a 5-year basis. We have to actively seek out these scarce yet lucrative and beneficial funds that look to create wealth for long term. Most funds nowadays seek to take on exorbitant levels of risk by placing all their bets into a single industry, attempting to fabricate short-term prosperity to charm investors. You cannot be a feeble-minded investor who only looks into short-term wealth generation. Always remember that when you're going through mutual funds, that is one thing I've seen successful investors look through. It is like something they keep on repeating, a mantra. Don't go into short-term wealth generation funds. Don't go into short-term wealth generation funds. So be circumspect for that. Essentially, we can say that there seems to be a disparity between us, the perspicacious investors, and the mutual funds' intentions. Nonetheless, we cannot pin the blame on these AMCs as they're simply pandering to the common investor's mindset. How do these funds get soaring returns in such short periods of time? Well, they invest heavily in a single sector, praying that sector prospers. Yes, there are legislations to regulate how much a single fund can invest in a single sector. Nonetheless, the fund can invest in corporations that are indirectly affiliated with the industry it is placing all its bets in. For instance, let us say Fund X wants to invest all its money in the IT sector. Assume that the SEC has mandated not a single fund can invest more than 20% of its assets in the IT sector. So the fund will then invest in firms that regularly interact with companies in the IT sector. For example, let us say there is a HR corporation that mostly provides its resources to IT firms. A fund would then invest in the company, and that would not interfere with the regulations imposed by the SEC. Why don't they diversify? Why don't they diversify their portfolio, you may ask? Well, a diversified portfolio will still proliferate above average returns. Nevertheless, a bet that materializes would result in greater returns but carries more risk. It's like betting in Las Vegas. It's that type of betting. The caveat that arises with this is that if the bet does not materialize, i.e., the warrants are fallacious, all the investors' capital is eroded, leaving you unsatisfied and flummoxed. For the AMCs, they have innumerable mannerisms through which they can essentially disassociate with the fund and form new funds. Additionally, they will still net management fees and sales fees. So it is a loss for you, but a win for them. Moving on, let me discern the guideline you should employ when investing in mutual funds. Though I have explained to you how AMCs operate, you must keep this in mind because this is what forms the basis for the guidelines I will present. First, judge the rolling returns of the mutual fund. Rolling returns represent the average annualized return of an investment for a given time frame. Specifically, rolling return calculations measure how a stock, mutual fund, or other security performs each day, week, or month from the time frame's beginning to ending dates. If you're interested in using rolling returns to evaluate different investments, there's a step-by-step process you can follow to calculate them. The first step is choosing a start date and end date for which to measure returns. For example, say you want to measure rolling returns for a particular mutual fund over a 10-year period. If you're specifically interested in how well the fund performs in recessionary environments, you may set the tracking to extend from January 1st, 2006 to January 1st, 2016. The next step is determining the return percentage generated for each year of the period you're tracking. To do this, you need to know the starting NAV and ending NAV for the mutual fund for the applicable years. Take the ending price and subtract the beginning price. Then divide that amount by the beginning price to find that year's returns. Next, you'll use averaging to calculate rolling returns. Add up the return percentages you calculated for each year of the time period you're tracking, then divide the total by the number of years to get the average annualized return. If I simplify this for you, essentially what they have done is, let's say your January 1st, 2006 to January 1st, 2016 period, you're trying to track the rolling returns. So what you're going to do is that you're going to take the starting NAV of January 1st, 2006, and then the ending NAV of January 1st, 2007, and then use the percentage change formula, which everyone knows, which is new minus old over old. So you would do the new NAV minus original NAV over original NAV. So that's going to be the returns for that year. And you do this for each and every year. So January 1st, 2007 to 2008, January 1st, 2008 to 2009. And you do this over a 10-year period. Then you add up all the returns. So 17%, let's say 31%. You add them all up and you take the average of the returns. And everyone knows the average formula. It's the sum of all the terms divided by the number of terms. So you add up all the percentages, divide them by 10 because you're doing it over a 10-year period. And you're calculating 10 percentage changes, I believe. Yes, 10 percentage changes. And then you will get your average rolling return. Essentially, rolling returns give you the average returns by a mutual fund over a period of time. Therefore, you can see the consistency of the mutual fund. Rolling returns are much better than trailing returns because trailing returns only give you a snapshot as to the growth of a fund's asset. Trailing returns are not comprehensive. So trailing returns are essentially when you have a start point and end point, and that's it. So basically, we were finding the average of all the trailing returns in that 10-year period. So trailing return would be, for instance, January 1st, 2006 to 2007. That's the trailing return. The return in that period is called a trailing return. Second, gauge whether the fund has diversified their assets. You can utilize many free websites to see where a fund has invested its capital. Additionally, compare the fund's diversification to other funds. The more diversified the fund, the better. Thirdly, inspect the fund's managers and AMC's record. This will shine light on both the acuity of the fund manager and the AMC's prowess. For instance, if the AMC has 5 funds and only 2 funds are doing well, you will assume that this AMC got lucky and you should withhold your investments from that fund. Fourth, view the fund's track record. See how it has coped with hardships and how has it capitalized on opportunities. Fifth, compare the expense ratio with other funds. The lower this better, as more of your money will be converted into investments, thereby netting more returns. We have covered the types of expense ratios in the previous episode. Essentially, they are fees that are taken from your investment so that the company can pay and offset any liabilities such as the salaries of analysts, marketing, etc. Sixth, be circumspect when it comes to portfolio turnover. The fund manager should maintain a balance between holding shares and selling shares in the short term. If there's excessive turnover, it simply means the fund manager is not confident with his investments, thereby depicting the fund as effete. Nevertheless, there's one thing to be wary about. Assume you invested in a fund that has a low turnover ratio. Suddenly, you see a sudden hike. This means that most of the old stock has been replaced with new stocks. Immediately, scrutinize the fund. Research and check whether the fund manager has permuted, whether the scheme has merged with another scheme, or if the scheme was reclassified. If this has been done, withdraw your investments from that. It is a major red flag. Additionally, the higher the assets under management, generally the better. This is because a higher AUM, which is assets under management, translates to essentially an increased confidence in a fund. However, do not invest solely on AUM. In fact, do not invest because the fund met only one parameter. It must meet most. It must meet most. A high AUM can be due to a plethora of factors. Thus, a higher AUM does not exactly result in greater returns. Nonetheless, it can symbolize the trust investors have in a fund. We must also consider the alpha of a fund. The alpha illustrates to the investor explicitly how has the fund prospered in comparison to a benchmark. If you invest funds in the stocks of a company that has Nifty as a benchmark, its performance is measured against it. So if Nifty, which is an index in India, gets a return of 10% in a year, and your fund's alpha is 2 in the same year, it means your fund got 2% better returns than Nifty. In other words, your returns are 12% for the same year. It is better than the Sharpe ratio, and of course, the higher the alpha, the better the fund. It means that they're outperforming a certain index much better. For instance, why should you invest in a fund that does not perform as well as Sensex? It doesn't make any sense. Then you should just buy an index fund. We then also have beta. Beta tells us how volatile a mutual fund is in comparison to its benchmark. A beta greater than 1 means that the fund is very volatile, whereas a beta lower than 1 means the fund is not as volatile/risky. The same notion applies to the standard deviation of mutual fund, wherein the higher the standard deviation, the more volatile the mutual fund. Of course, this beta is also pegged against a certain benchmark. Generally, the lower the beta, the better, since you don't really want a volatile asset. Finally, let us move on to common mistakes you should be circumspect of when investing in mutual funds. Firstly, many investors believe that lower NAV translates to more units and therefore more returns. This is completely erroneous. Let's take an example of this. Now, this is going to be slightly complicated, so if you have paper, just write down what I'm saying. Let's say there are 2 mutual funds you're willing to invest $10,000 in a mutual fund. Mutual fund 1 has an NAV of $100, therefore you will receive 100 shares or 100 units. Mutual fund 2 has an NAV of $10 and hence you will receive 1,000 units. Now there's been an increase in the NAV of each mutual fund by 30%. So mutual fund 1 has an NAV of $130, whereas mutual fund 2 has an NAV of $13 now. To calculate the amount of money you will earn from withdrawing your funds, we multiply the NAV by the number of units you hold. Thus, 13 times 1,000 gives you 13,000, and so does 130 times 100. Therefore, we have nullified this myth because we can see that lower NAV does not mean that you'll get more returns because you get more units. That's completely wrong. If you think about it, it's basically an inversely proportional relationship you have seen. The lower the NAV, the more units. And in an inversely proportional relationship, there is always a constant, which is K. So therefore, that's another way through which you have nullified this myth. The second mistake I see investors make is individuals invest in sectorial funds at times. This again relates to our initial depiction of most funds. They place all their bets on one sector, and if anything goes wayward, all your capital is eroded. There is a surplus burden of risk associated with this investing method. Therefore, it should be avoided at all costs. Yes, sometimes you do get lucky, like the pharmaceutical um, sector fund, but it is very risky. So I would say refrain from investing in such sector funds unless you're 130% sure, 120% sure. Third thing, investors tend to invest in as many funds as possible. Only allocate your money to funds that have passed through your intensive checks. At most, you should invest in 2 to 3 funds. That is at most. Why is it bad to invest in so many different funds? Well, you would have invested indirectly in most of the corporations in the nation. Thus, your returns will be congruent with an index. At that point, you should have just invested in an index fund. Fourthly, if a fund appears to give promising returns but has a slightly higher expense ratio, just invest in it. Do not eliminate a promising fund simply because it has a slightly higher expense ratio. This is, of course, ultimately up to your discretion. Think about it this way. If you have two funds, one offering a 25% return and 2% expense ratio, whereas you have another fund which offers maybe a 12% return but only a 0.5% expense ratio, you should go with mutual fund one. It doesn't make that much difference in the long term. Finally, do not frequently exit funds. You're damaging your long term gains if you utilize this strategy. Tax deductions will constantly be charged as you withdraw, thereby diminishing your gains and impeding you from maximizing your returns. And that concludes today's episode, which is investing in mutual funds. In the following podcast, we will be discussing evaluating shares, trading bonds on the secondary market, currencies, index funds, etc. Thank you for listening to today's podcast. Please leave any improvements in the comments. Goodbye and see you on the next episode.